everyone, this is Dr. Barry, and we're going to talk about other commercial property coverage forms today, which is from CPCU Assignment 5. What we've been talking about up until now has mostly been the building and personal property form out of the commercial package policy, but these are some other forms that were developed by the Insurance Services Office, so they're ISO forms for other more specific and unique exposures and coverage needs. And to begin, we're going to talk about characteristics of condos and similar property. So a condominium or a condo is defined as a real estate development that is a group of units, usually attached to each other, that could be apartments, townhomes, or offices. A unit is a portion of the condo owned solely by one owner or owners, as opposed to jointly by the condo association. The condo association manages the condominium and owns the common elements. So as you can imagine, between the unit and the condominium association, when it comes to insurance, you have to consider who owns what in determining who is responsible to insure what and who is responsible first to replace what property. Condos, cooperatives, and PUDs may require specialized policies because of their combined ownership structure that we were just talking about. The first thing an agent or broker or underwriter who is either working on a condo association insurance policy or helping a condo association or unit owner to purchase insurance to protect their property is they have to look at both the applicable states enabling statutes applying to the condo ownership interest and insurance and the condo association agreement. States have laws that relate to ownership interest and the purchase of insurance, and these laws can be very different from one state to the next. But possibly even more importantly is the detail within the condo association agreement itself. The insurance requirement should be spelled out in the governing agreement or bylaws of the condo association agreement. They should also clarify the rights and responsibilities of the unit owners and the association, particularly with respect to insurance. It's important to find out from the condo association agreement who owns what. The condo unit owner always owns the box of air within the walls of the condo, and more importantly, any property within the unit, with some exceptions. On the other side, the condo association owns common building elements, exterior walls, interior walls except those within units, columns, beams, and storage, recreational areas, roofs, parking, pipes, wires, conduits, and other utilities. The condo association is made up of all unit owners. Then there's things that may be owned by the unit owner or by the association. Some property contained in the unit, for example carpets and appliances, and improvements and betterments. Who owns what of this type of property depends on which approach appears in the condo association agreement. There are three different ways of approaching this. One is the bare walls concept. This is the approach where the association owns the least amount of property, and the owner owns the most. The association with the bare walls concept doesn't even own paint on the walls. So when you think about the term bare walls concept, you're thinking in terms of what the condo association owns. All they own is the walls even before they're painted, whereas the unit owner owns everything inside, including the paint and any kind of improvements and betterments and countertops and things like that. But the condo association owns nothing within the unit's walls, not the appliances, not the cabinets, not the countertops, etc. The single entity concept is kind of in between the three. The condo association owns all property in the unit at the time of sale: cabinets, carpet, and appliances. And then lastly, the all-in concept, which is the opposite of the bare walls concept, where the condo association actually owns the most and the unit owner owns the least. It means then that the condo association has to insure the most, and that's something that you need to keep in mind when thinking about all of these, that whoever owns the most also is responsible for replacing property that is damaged or destroyed or stolen, and therefore is responsible for insuring that property. This can get pretty complicated when the all-in concept applies. The association owns the same as a single entity, but also owns improvements and betterments, which are the most complicated part of this equation. The association can easily be underinsured if they're not careful, because it's hard to evaluate the cost of improvements and betterments. Some condo associations will actually charge an additional premium for improvements and betterments. So even just looking at this picture and thinking about what kinds of things, if this were a condo, that might be improvements and betterments, this island here, and maybe some of the permanent art on the walls, maybe the crown molding here, all of this could have been added after the condo owner moved in. Knowing how to evaluate the cost of those might be difficult, especially if the condo owner hasn't informed the condo association of the improvements and betterments. The responsibility for ensuring improvements and betterments for the condo association can also cause coinsurance problems. Remember that if you're required to carry 80% coinsurance, and at the beginning of the policy period you're actually carrying 80%, if the value of the property increases over time and your limits don't increase, the percentage of insurance that you are carrying, insurance to value, will go below 80%. Some condo associations use the agreed value option because this eliminates the possibility of a coinsurance penalty. You might also use blanket insurance to avoid the coinsurance penalty when separate buildings are spread over several acres. This way it would be highly unlikely you'd be risking a catastrophic loss, and you can have blanket coverage over several different properties, giving you additional coverage at each individual property. There are other similar forms of ownership that I mentioned before. They are cooperatives, where the tenants do not own the box of air, but actually own stock in the building. However, even though the tenants do not own the box of air, they might be held responsible for maintenance and for insuring fixtures. There are also planned unit developments, or PUDs, also known as homeowners associations. With these, the association may or may not need to insure any jointly owned property, such as recreational areas or common walkways. So every condo association faces the question how much to insure. The rule is, when in doubt, the condo association should obtain the broadest coverage. The unit owner, however, should not do this, because you don't want the unit owner to be overinsured or to have duplicate coverage. The association should tell unit owners what they need to insure. So let's look at the condo association form. Let's start with a look at the building coverage. This coverage closely resembles that of the BPP. The coverage only applies to property contained within the individual units, such as fixtures, improvements, alterations, and appliances, if the condo association agreement requires the association to insure them. Now let's look at your business personal property. Coverage applies to the personal property that does not already fall within the scope of building coverage, for example, furnishings and equipment of community clubhouses, recreation halls, and health clubs. Coverage does not apply to business personal property. And then with respect to personal property of others, coverage is the same as the BPP. If 80% or higher coinsurance is in effect, in other words, the insured is carrying 80% of the value, the form automatically includes a coverage extension for property of others, up to $2,500 at each described location. Additional insurance can be added under personal property of others coverage endorsement. Now let's talk about the conditions of the condo association policy. It's best for the association to designate a trustee. A board of trustees of the condo or a group of unit owners is usually the association trustee, or they can designate a financial institution to be the trustee. If the unit owner has coverage, the association coverage is primary to the unit owner's coverage, and the unit owner's is secondary. An insurer agrees not to subrogate against the unit owner in the conditions of the condo association policy. Now let's talk about the condo commercial unit owners coverage form. Unit owners in residential condominiums would use an ISO HO6 form, which we studied in Insurance 205. Unit owners in a commercial condominium, offices, or stores could use the Condo Commercial Unit Owners Coverage Form. This is like the BPP, but it doesn't have the same building coverage as the BPP. It includes only your business personal property and personal property of others. One note on this, business personal property includes improvements and betterments to the extent of the unit owner's use interest. There are also two optional coverages. Loss assessment, which pays for any assessment by the condo association, which pays the unit owner's share of any assessment charged to all unit owners by the condo association, as long as the direct physical loss is caused by an insured peril to the property. This could be something like the main office of the condo association. Secondly is miscellaneous real property coverage. This extends coverage to include condominium property if the property pertains to the named insured's unit only. For example, a balcony that's been attached to the property. Now let's switch gears and talk about the Builder's Risk Coverage Form. The Builder's Risk Form insures the unique exposures that can't be insured by a building and personal property policy. When property is being built, the property value increases over time, and there are a variety of interests involved. Additionally, there are increased hazards during construction. So for all of these reasons, a building and personal property form is usually not sufficient to insure the exposures associated with builder's risk. So let's look at builder's risk coverages. The ISO Builder's Risk Form covers buildings under construction, including foundations, temporary structures built or assembled on site, as long as they are not covered under other insurance, and the following property: fixtures and machinery, equipment used to service the building, and building materials and supplies, provided that those materials and supplies are intended to be permanently located in the building described in the declaration, or to be permanently located within 100 feet of the building. It also covers personal property, for example, uninstalled windows, doors, sinks, furnaces, as long as they are intended to be permanently installed. Now let's look at some important builder's risk policy considerations. Certain property is excluded on the builder's risk form. Land or water, lawns, trees, shrubs, or plants, antennas, and signs not attached to the building. So there are fewer exclusions in the builder's risk form than in the building and personal property form. There are also some additional coverages and coverage extensions in the builder's risk policy. For example, it contains coverage for debris removal, preservation of property, pollution cleanup, and fire department service charges. The builder's risk form does not provide the additional coverage for increased cost of construction, electronic data, or for any of the 6 coverage extensions included in the BPP. You can add these extensions: building materials and supplies of others, and sod, trees, shrubs, and plants. Causes of loss. Like the BPP, the builder's risk policy must be combined with a coverage form, broad, basic, or special form. Note that collapse is specifically excluded. Collapse of a building, however, can be covered by adding the builder's risk collapse during construction endorsement. The endorsement, in return for an additional premium, reinstates the collapse coverage and extends it to collapse during the course of construction, remodeling, or renovation. Theft is also a particular problem at construction sites. The basic and broad form do not cover theft. The special form covers theft, but not theft of building materials and supplies that are not attached to the building. Now let's look at some alternate methods of valuation for builder's risk coverage. There is the completed value approach and the builder's risk reporting form. With the completed value approach, limits are the full completed value of the building at policy inception. This is usually issued for 1 year, a refund of unearned premiums if the construction is completed in less time. With the completed value approach, there is generally a need for adequate insurance condition. This is essentially like 100% coinsurance. The amount payable with a policy using the completed value approach is the limit of insurance divided by the completed value times the loss minus the deductible. There is no underinsurance penalty as long as, at the time of the loss, the limit of insurance equals or exceeds the building's completed value. The value of all permanent fixtures and decorations that constitute a part of the building must be included in the completed value calculation. The other alternative is the builder's risk reporting form. This is much like the value reporting form that's usually used for inventory with the building and personal property form. It's really not the preferred method, though, because it's very costly to report and to keep track of. There's also a fair chance of being underinsured and penalized for not having enough insurance. Now let's look at a standard property policy. This policy covers buildings and personal property on a restricted basis. It is a monoline policy covering only property exposures. Liability coverage must be obtained separately. This policy is good for distress risks because for these risks, insurance is unavailable or unaffordable. So if they went to the market and tried to purchase a building and personal property form, they would find that it was either too expensive or they were denied entirely. These types of policies are often used by state residual markets, such as FAIR plans, or in the state of Louisiana, the Citizens Insurance. The cause of loss coverage on these policies are similar to the basic cause of loss form, but even more restrictive. Additionally, there is no replacement cost option. All property is covered at actual cash value. Now let's look at the legal liability coverage form. This provides property damage liability coverage, physical damage, and loss of use on buildings or personal property of others in the insured's care, custody, or control. The BPP provides this regardless of whether the insured is liable. This form only covers loss if the insured is legally liable, so it is less expensive. The CGL excludes coverage for damage to property of others in the insured's care, custody, and control. So a business could get legal liability coverage for personal property of others from the BPP, but it might be very expensive if they have a significant exposure in this area. So to make sure that they're at least protected if they are legally liable, they might purchase the legal liability coverage form. This would be particularly good if a business is storing a significant amount of others' property. Now let's talk about the leasehold interest coverage form. This ensures a tenant's financial loss from a canceled lease, which might occur when a rental rate is much lower than the going rate, the lessee has sublet premises for a profit, or a lessee was paid a bonus to acquire the lease. This form is seldom used either because of lack of awareness or because it is too small an exposure. And that's the end of other commercial property coverage forms. Remember that if you have any questions, email me or come by during my office hours.